Inflation is deadly for stocks, but it's even more deadly for bonds. So it depends on what you think your worry is for markets. My worry, more than the economy, is inflation. And I think this is part of a broader theme with catastrophic risk in investing. You know what? We deny it. We act like it's not there. Fed rates. I wouldn't be surprised if you saw the Fed raise rates rather than cut rates during the course of the year if inflation doesn't come down.
Welcome to our latest video where finance expert Aswath Damodaran dives into the revolutionary impact of AI on investing. In this session, recorded in Brazil, Damodaran discusses how the convergence of big data and immense computing power is reshaping the financial landscape. He highlights the advantages held by tech giants like Google, Amazon, and Microsoft, and explores the implications of recent dividend announcements by Meta and Google. Stay tuned to understand how AI is driving change and what it means for investors in the tech industry.
I've been as you know, I track markets on a monthly basis, looking at the equity risk premium. And April, when I did the update, April 1st, it was peak momentum for markets. Everything looked amazing. If you remember, the story was inflation has been conquered, Fed's going to cut rates, the economy is back. And 4 weeks later, it's amazing how much the mood has shifted on big questions, right? All of a sudden, there's this worry about, is the inflation as strong as is the economy as strong as we thought it was? Maybe, I've read a few stories, but maybe inflation will never drop below 3%. Fed rates, I wouldn't be surprised if you saw the Fed raise rates rather than cut rates during the course of the year if inflation doesn't come down. But it tells you how much markets are driven by mood and momentum. And I think this month will be a make or break month because the mood continues to shift down. We'll be heading into the summer in a bad mood with momentum kind of against us. And you put on top of it a presidential election and political instability. We could be looking at a pretty bad year by the time we're done. And it's across sectors, and if there's an adjustment, you're going to see it cut across. So for the moment, that's what I'm keeping my eye on, is that mood and momentum factor. There isn't a sector that I can point to say that sector is obviously undervalued right now. It's because collectively, I think everything's been pushed up so much that you look at beverages, you look at technology, everything is trading at a much higher multiple of everything than it did a year ago, 2 years ago. But I think you're just one big correction away from things starting to pop onto your radar saying that's been pushed down too much. I think the entertainment space is an obvious space where I can't buy Disney because my son works at Disney, so I don't want to create issues with them because that's one reason I don't value Disney or write about Disney, though I have lots of thoughts about Disney because I use it in my class. But to me, Warner looks interesting because it doesn't have the Sherry Redstone effect that I would get with Paramount. And I think the content, ultimately, I don't care if you're an entertainment giant. Without the content, what exactly are you going to stream? So I think the content is interesting enough. And ultimately, I think somebody's got to be in charge of the content. And Disney and Warner are still better at creating content than Netflix is. Netflix throws a lot more money, but it creates a lot of crap along the way. So I think that, to me, there will be more businesses like that show up on my radar. Now, I'm interested in PayPal as a company. I'm amazed at how much the mood has shifted from PayPal being this high-flying financial service company to it's boring and nothing's happening. I have companies that I have on my list that I haven't bought yet that I want to wait through May and see what happens, because I'm just one downturn in the market away from saying, oh, those companies look good. So, and I would say the same thing to the person who says, well, can I ever buy NVIDIA? And my reaction is, in the last 15 years, NVIDIA has been cheap at least 5 times on an intrinsic value basis. It's not been an all upswing. The reason I bought NVIDIA in 2018 is people were beating it up saying this is the end for NVIDIA. There will be a time on every one of these companies where it's the right time to buy. It might not be right now, but patience has its own rewards. In general, you're right. Fixed income clearly is, for a decade, it was equities or nothing, right? You earn nothing on T-bills, nothing on bonds, even AAA rated bonds, you were earning 2-3%. And I think that we have more choices now, and I think we need to look at those choices. I don't think you can make, to be quite honest, the 10 to 12% with no risk comes from the fact that when lenders and bondholders look at risk, it's always backward looking. There's been no default in the last decade. Based on that, it looks pretty safe. But we know that at least in bond markets, default risk is highly correlated, which means that if there's trouble, there's a tipping point where all your bonds get into trouble at the same time because of some macro event. 2008 was a classic event. Bonds that look safe all of a sudden start to blow up on you. But I do think you can make solid returns. I tiptoe into this because I've not been a big fixed income person, but I'm much more conscious about sweeping my money into T-bills where I make 5.5% a year. That's a lot of money to leave on the table if you have it in cash. Would I lock in bonds? The reason I worry about bonds is the same things that would bring equity markets down are the things that will bring bonds down even more. For instance, if you think inflation is your big worry, that it might explode, it's going to bring equities down, but it's going to be far worse for bonds because you have no pricing power to increase your coupon. Your coupon is stuck. So the 10 to 12% is assuming that you effectively are going to stay in this debt and that you collect the interest payments with no default. But the price of debt, especially if it's long-term debt, is a function of what's happening to inflation and interest rates. And as we saw in 2022, I mean, stocks were down 20% because inflation went up, but bonds had a return of minus 22%. It was the worst year for the bond market in a century. Inflation is deadly for stocks, but it's even more deadly for bonds. So it depends on what you think your worry is for markets. My worry more than the economy is inflation. Because in my experience, inflation is incredibly stubborn. You think you've conquered it, but it finds a way back. And I think as we've seen in the last 3 years, you think you've got it nailed, but then it comes back because it seems to seep in through other channels. And if inflation is my worry, I'm just as exposed, perhaps more so, if I put my money in long-term fixed income as I am in equities. I mean, I don't want to waste your time, but I want to give you a little bit of background to how I wrote that paper. It started with an email I got from somebody in Iceland reading, who read my blog. He said, look, I'm an appraiser in Iceland. And one of my jobs is to appraise the value of this company or business called Blue Lagoon. Blue Lagoon is this legendary Icelandic spa. And it's been around a long time. It's great margins, great profits, but it's facing an existential threat, which is the volcanoes that have become active in Iceland. The lava is flowing in the direction of the Blue Lagoon. And he said, how do I incorporate that risk into my value for the company? It's too late to buy insurance, obviously, because the answer is go buy insurance, build in the cost. So it started me thinking about how do we deal with catastrophic risk in investing in valuation. So I was walking my dog on the beach, which is where I do much of my thinking. And, I was thinking about this and I said, before I point fingers at other people not dealing with catastrophic risk, I just walked out of my house, which is 2 blocks from the Pacific Ocean, and sits on an earthquake fault. And I paid $2.5 million for this house. Did I bring in catastrophic risk into the valuation of this house? I mean, I'm one tsunami away or one earthquake away from the house becoming rubble. And my earthquake insurance is very limited. It's not going to rebuild the house. And a tsunami, I don't even have tsunami insurance, so I don't even know what would happen if that happened. I said, I'm not building it in. And I think this is part of a broader theme with catastrophic risk in investing. You know what? We deny it. We act like it's not there. And I think there's a reason for it. I use this example of an apocalyptic movie, Mad Max Beyond Thunderdome. I said, go watch the movies, check to see how many times people in that movie check what their portfolio is doing. Nobody does, right? It's survival. So I think in a strange way, as investors, as businesses, we shut off catastrophic risk. We pay $500 million for a building in downtown Manhattan, even if we believe that climate change is going to put Manhattan under water, because our view is what's the point of even bringing it in? It's not, I mean, at that point, my portfolio won't matter anyway. Life is going to come to a standstill. I'm either going to live or not live. And I think that's part of a broader issue. In business and investing, we tend to ignore catastrophic risk entirely. In fact, I think there might be lessons there for the climate change folks, which is if you preach catastrophe and you ask people to behave better, it's not going to happen. It's like telling people that they have 60 days to live and saying, can you live more healthily? Eat, if I have 60 days to live, what difference does it make? So if you want people to behave better, maybe less catastrophe forecasting and more there is hope and you can change things. But I think it's part of, I mean, I think we're starting to grapple with the question of catastrophic risk and how to bring it in. But it was just very early in